So we're diversifying, but we're not buying everything, right? We're being selective. That's kind of what I mean by managing your portfolio like a boss, is that you're trying to pick and choose based on the data what asset classes are in favor at this very moment.
You are going to get left behind in this economy because your finances are not well positioned. My name is Khayri. I'm here to expose the right way for retail traders and investors like you and me to approach financial markets. So before you start day trading or buying financial products, you need to understand certain principles to ensure you're well positioned to build wealth over the long term. This is how a really good trader is formed, by trading with a purpose and a more significant objective. So, do you want to learn how to construct the best wealth building portfolio? Then I suggest you click the link in the description to purchase my book, One Small Tweak. This book will expose precisely what products go into our foundational portfolio and then how to tweak these products for superior performance. And lastly, for your life insurance needs, I am currently offering a free 15-minute call. So, whether you're someone who needs consultation on the best policy type, I specialize in term policies and policies that are designed to build wealth.
Welcome back to another episode of Well Positioned. This is your host, Khayri Graves, back with another video. I appreciate y'all for all the views and the comments and the likes and the subscriptions to the channel. It truly means a lot. And we're just going to keep growing. We're going to keep updating and educating ourselves with what's going on in capital markets in the world of finance. There's a few things that are going on in the market that I'm paying very close attention to. As you can see, or maybe you have not been paying attention, but the market is in the middle of a pretty decent pullback. We've seen the markets have been down pretty much since last week, having some pretty big declining days in percentage terms, 1% or more, almost 2% some days, and across the different indexes. The S&P 500, the NASDAQ, the Dow Jones, they're all getting hit pretty hard to the downside. And when we're in the midst of this type of market volatility, it's very important that we're paying attention to what exactly is going on underneath the surface. Because sometimes when the market pulls back, it's very likely for us to feel helpless, right? We feel like, there's nothing I can do. The market's just falling. I'm not smart enough to hedge or time the market. I don't want to pull my money out of the market and then the next day it reverses and goes back up again, and then I missed out on the market turnaround. And sometimes it's very confusing on how to maneuver during a market pullback, and that's okay. That is a very common feeling whenever we're dealing with these markets. And one of the things I want to portray is that the data really helps us to get a grasp of what is going on. And a few of my last videos, I talked about how, as the market is changing and as we're looking at things like more inflation and the Fed pushing back on, lowering interest rates due to how high and how aggressive inflation has been, we're paying attention to that. And a lot of things that I did and I spoke about in previous videos was positioning our portfolios to have some allocation to assets that do well during times of inflation. Now, stocks in general typically do well in times of inflation, but assets such as commodities, energy and things like that, those sectors of the market tend to do and outperform better during times of inflation. That was one of the pivots that I made going into Q2 of this year. And it's worked out pretty well because it's kind of protected my portfolio from completely absorbing all the losses that the rest of the market has been experiencing. But nevertheless, of course, I'm down, over the last couple of weeks like everyone else is, but I'm paying close attention to what is getting hit the hardest and what is kind of acting more favorable. We see gold being treated very well during these, pretty much since the beginning of the year. Gold has had a great increase in price relative to the market, is actually outperforming the market. And when you see things like that, you have to not be worried, but definitely be cautious, and you want to pay close attention to what is going on. There's a lot of geopolitical risk out there between what's going on in the Middle East and some of the Eastern Europe territories. Like there's a lot going on all across the globe, and it's affecting oil prices. It's affecting gold prices, and it's also affecting market volatility. So in this video, when we're talking about managing your investments like a boss, that really goes into just having a grasp on your investment business. This game that we're playing in these capital markets is a business, right? And we have to understand that we have to keep our CEO caps on and be the investment manager, the chief executive officer of our investment portfolios. And doing this is going to allow us to be comfortable with the risks that we're taking, and it's going to allow us to capture more upside because we're paying close attention. One of the things we don't want to do is overtrade. We don't want to be very speculative, especially during times when it doesn't call for it. But we just want to make sure that we are well positioned into the right assets as events and things are unfolding. And sometimes even just paying attention allows us to make incremental, smarter decisions. Like maybe you're set up to buy stocks on a monthly basis. And so, you transfer money into your investment account every month at the same time, and you just do a systematic buying process. Well, during times like this, you may say, you know what, I'm going to transfer the money, but I'm not going to buy stocks this month or next month. I'm actually going to let my cash pile build up. And I want the market volatility to play out. And when I start to see signs in the data and start to see signs in what the market is telling me that things are going to look better in the future than they do right now, I'll have a larger cash pile. I'll have more ammunition to purchase stocks and assets at a lower price, and I'll be able to benefit and capture even a better gain over the long term by doing just small incremental moves like that. And that's kind of what we talk about a lot when we talk about, being in the right vehicles, right? Being in the right assets, in the right vehicles, and not timing the market, but just being strategic about how we're allocating capital. We're structuring a portfolio. We're using percentages and pie slices within our portfolio to understand what we want to be positioned in. And then we're also attaching all of that to a risk-based investment framework, and we're doing that all based on what is going on in the markets. And that's why I often say in every video, pick up the book One Small Tweak. One small tweak is going to help you set up that foundational investment setup and saving setup and getting into the vehicles that you need to be positioned so that when you're ready to start making smarter moves, you're already doing it from a much better foundation. And that's what the book offers. Right, so let's dive into these markets here. I want to pull up, of course, our favorite index of all time, which is the S&P 500. I want to pull up the S&P 500 because I want to get an idea of where we are thus far. So we've had roughly a 4% pullback since the peak that happened on the week of March 25th. So 4% pullback from the peak, but year to date we're up still about 7%. So, a few percentage off the peak, we're still up for the year. So that's definitely still a good sign and still leans me to be bullish. Once we start, cresting and start losing some of the gains that we've achieved thus far this year, that's kind of when you start to be more cautious. And if we just kind of peel back where we were from the November pivot that we had in stocks, this was right when Jerome Powell pivoted on his interest rate raising cycle, and 20% or so we could take. So, like I said, those are good signs that we aren't seeing crashing markets per se. We're seeing a modest pullback. It's modest right now. This obviously could get way worse. Obviously, every bear market starts with a small pullback, if you will. And unfortunately, there's no one that's going to ring the bell at the top of the market to let us know when it's time to get out. However, there are a few things that we can do.
And a couple of things that we can do is kind of get an idea of, so we're pivoting over to Yahoo Finance, and I just want to look at like some relative strength across the board and get an idea of like what was doing well, or I guess better than the overall market. So we see that the market today, and mind you, this is April 15th, 2024, the market was down 1.25% for the day. We wanted to kind of peel back the hood and say, okay, so the market was down 1.2%. Let's look at some other indexes or some other, indicators or ETFs or other assets that maybe didn't do as poorly as the market was falling. So we see the S&P 500 fell 1.2%, but we look at something like the Vanguard Dividend Appreciation Index that fell 0.69%, much less, almost half of what the S&P 500 fell.
So that's very important to look at because we're seeing from a relative strength standpoint that something like a dividend-based ETF actually held up better as the entire market was pulling back. And if we just want to see like, well, what's in this VIG, this Vanguard dividend ETF, we see Microsoft, Apple, Broadcom, JP Morgan, ExxonMobil. So like a lot of the bigger dividend paying stocks that are in the markets. And we see that this is well diversified, right? So it's not so technology heavy. It's not financial services heavy. It's a good mix of some of the more safer names, if you will, names that are, strong companies that pay strong dividends. And when I saw this, what I would start to do and what I like to do is to say, well, it may be worth pulling back from some names that, such as like if we're looking at QQQs, which is the NASDAQ ETF. We saw this was down 1.65%. So we saw the S&P was down 1.25%, and now the NASDAQ was down 1.65%. So even more of an aggressive pullback. So we're kind of seeing from a relative strength basis what the stock market is liking more than others, right? And so comparatively, we see tech was one of these names that not so favored by the market over the last few trading days, kind of taking the brunt of a lot of the downside action that we're seeing. And we're looking at this ETF, 50% of its technology, not a very well diversified fund that we're seeing here with the NASDAQ. So that draws me to names like VIG, which was the name we just spoke about, the Vanguard Dividend Appreciation ETF. Another fund I was looking at, ticker symbol VTV, we see that this was only down 0.54% relative to the 1.25% downside we saw in the S&P 500. So, I'm looking at some of this stuff and I'm saying, the market is actually getting a little bit cautious because it's running into value names, it's running into dividend names, it's diversifying itself a little bit more and kind of not staying so heavy into tech and it maybe, selling out of some tech to get into some safer names. So if we see like this value fund is up 5% year to date comparative to the S&P 500, which is up 8% year to date, we can possibly start to see those names come back more into balance, where the S&P 500 comes down a little more, and the value funds maybe start to either hold their gains or maybe rise ever so slightly. And once we start to see that divergence take place, we kind of know that we're on the right side by getting a little bit more defensive. And now, why will we get defensive at a time like this? The reason we would get defensive at a time like this is because, inflation tends to have a way about it that slows down a lot of economic activity. And when consumers constantly every day, we leave our house and we're paying bills and we're seeing prices that are either rising or just not going down, it becomes very overwhelming over a longer period of time. Sometimes the initial inflation shock is like, oh my God, that's that much, and we pay it and we move on. But we keep coming back to these same higher prices, and it just kind of starts to curtail some of the economic activity that we involve ourselves in. And I think the market is starting to understand that may start to play out. And then what that will do is have an effect on economic growth, right? Consumer spending being, a large, I don't know what the percentage is, but a large part of our economic activity that will kind of hinder GDP gains that we've seen in the past, that may not be as robust as we've seen in past quarters. So that's definitely something to keep in mind, the burden that inflation can have on an economy over the long term. So a lot of times inflation is triggered by some of the input costs and the input items that go into production and manufacturing. So gold has a small industrial use case, but even that with a year to date price rise of 13%, that causes things like industrial activity to increase, or even silver, which is more of an industrial metal, up 17% year to date. I mean, you find silver in a lot of different industrial productions and things like that, and that that having a rise of this much, 17% year to date, that's going to cause everything else that's involved in that to be priced even higher, and then that cost gets passed down to the consumer. We also can look at something like copper. We see the price of copper is up 10% year to date, and you usually don't see returns like this from a commodity like such as gold, silver, and copper. But copper you can find in a lot of industrial production, and those costs are gonna get passed down to consumers. Last thing we'll look at is oil. Wow, I mean, we're looking at the United States Oil Fund, which tracks the price of oil, is up 22% year to date. Over time you start to see gas prices rise, oil prices rise, as overall energy demand, as it picks up, we're paying more for these commodities and these resources, and that starts to come into this like inflationary cycle where we're seeing prices going up and consumers paying more, and then it's showing up in the data, and in that over a long time, quarter after quarter, can hinder economic growth. And I think investors are starting to sniff that out. So I'm seeing positioning in commodities, I'm seeing position in resources and energy. I'm also seeing positioning in defensive names, dividend paying names. But one thing we're not seeing, and I'll leave off on this note, we're not seeing positioning into bonds per se. Even something like TLT, which is a 20 plus year treasury bond ETF, we see this has a negative 7.8% return year to date. One thing we're not seeing is the flight to safety in the forms of bonds. So that's why even though the market is pulling back, and I am a little bit worried about returns going forward for the market, especially with inflation being so high, and not even that it's being so high, but it's not coming down the way we would like to, and the way the Fed would like to. That would give the Federal Reserve the ability to cut interest rates and try to keep stimulating some of this growth that we're having. We're not seeing a flight to safety in the form of bonds. Investors aren't running into bonds, and for various reasons, because of how much fiscal spending on the federal government side is taking place, that the market is saying, with all this debt that we're taking on as a nation, investors are demanding higher interest rates on that debt. So that's why we're not seeing the flight to safety to bonds. At least that's one of the reasons. We kind of saw that same outlook since 2022. In 2022, we saw massive negative bond returns, double-digit negative returns, and we're starting to get close to seeing that again this year. And when that happens, we have to look elsewhere to get the safety that we may require in our portfolios. And we may find that in dividend names, we may find that in defensive names, and we actually may find that in some commodity like names. So we're diversifying, but we're not buying everything, right? We're being selective. That's kind of what I mean by managing your portfolio like a boss, is that you're trying to pick and choose based on the data what asset classes are in favor at this very moment, and what will be in favor as the future unfolds based on what we know now. The market doesn't have a lot to go off of now. What, may cause sentiment to change or shift in the markets will be the earnings coming up, right? We'll start to get the earnings from Q1 in the beginning of Q2, and there's a lot of suspicion that earnings may not be as robust as they have been in past quarters due to how impactful this inflation has been. We want to be mindful of all those things, and remember, we want to put our CEO caps on and manage our portfolios like a boss that we are. And I really encourage you to pick up the book One Small Tweak. We go into all of these things, and we keep it timeless, right? We speak in generalities, but we also speak in specifics in terms of how to allocate properly, what vehicles to be in, and how to have a long-term outlook on investing capital into the markets. And then once we have that foundational knowledge and information, then we can get into some of this nuanced stuff that we're talking about here, about getting the temperature and forecasting, what the market is trying to tell us. What is the market saying to us that we need to be positioned for? We can do this with a full-time job, right? I encourage everyone that has a full-time job to still partake in the markets. This can be your part-time job, right? You can make enough returns by positioning and allocating your portfolio in the right way. So hope this video motivates you to get involved into the markets, get a good foundation, and start educating yourself. Building wealth is going to be one of the things that will keep us secure and save ourselves over the long term from higher inflation, and just the cost of living just looks like, from what I'm seeing based on the data, is going to continue to increase. And we have to find a way to combat that. I've said enough for one night. I really appreciate you guys. Please don't forget to like, comment, and subscribe. And we'll be back with another one very soon.